and gentlemen, welcome to yet another episode of InvestSense webinars. I am Sankalpo. I represent the business development team at PMS AIF World. And we've been doing these series of webinars over the last 1 year now. And the intent of these webinars is to talk about different portfolios, different market ideas, and different opinions from different kind of fund managers. The ultimate motive is that we help you, invest better, and that is why we call it InvestSense as the genesis. And keeping in that tradition, we have Satwik of Generational Capital. He is the executive head at Generational Capital, executive chairman at Generational Capital, and he also has been a golfer representing India. It's very interesting about him, and I think a lot of his investment temperament comes from playing golf. About his professional career, he was he was a part of the product team at Client Associates, which manages around $4 billion US $4 billion US dollars in Indian of Indian families. He also was one of part of the four-member team at Elara India Gateway Fund, which managed close to 40 million US dollars, and he also did M&A deals at Deloitte's. He advised on M&A deals at Deloitte's upwards of US dollar 10 billion. He was also the co-founder of an app called fitnessholic.com. If I think I got the name right, and
Right.
it was a platform aggregating over 150 fitness centers over the country. He's been he's quite often seen at different platforms talking about businesses, and we welcome him. He will discuss about his perennial fund, which tries to create an all-weather approach to building wealth and wealth creation in equities. So we will know more from him. Audience, I'm getting no voice comments in the chat, so if you can just give me a yes or no, so that we can go ahead, or we will check. So Mr. Sunil says that no voice. Can I get some replies on the chat that if you've gotten voice? Also, Satwik, before I begin, let me just give you a little bit of anecdotal, evidence on anecdotal discussion on the audience that we have today. Okay, voice is fine. Voice is fine. Good. So I asked on chat. This is the best bull run I have seen. 88% says yes. No says only 11%. Okay. So let's take it head on from here. Okay, we've gotten a lot of messages on the chat saying voice is fine. Good. We hope. Okay, someone saying I look less energetic. That's not the case. I think you will see it in the coming episodes. In the coming few minutes. So we'll begin with that, and the audience is enthused. They feel that 80% of them feel this is the best bull run, and we are discussing a perennial fund kind of a concept. A perennial, which is often associated with a river source. Perennial means that the river is not fed by rainwater or any other phenomenon. It is more like an ice glacier melting or something like that, which feeds the river constantly. So that is what we want to talk about in today's episode. So what do you, Satwik? And let's take it head on. Thank you.
Right. So I'll just give a brief about myself, and so can we start the presentation?
Satwik, you stop the screen sharing. I'll start with the presentation.
Right. Thank you. So I would like to give a brief introduction about myself. Sankalpo gave a lot of it, so I'll just delve a bit more deeper into it as to how this fund came into being and what we are doing. So basically, I was an international golfer playing for India in over 100 tournaments. Then I had this injury on my wrist. So with playing golf, what you realize is you have to be the best each day. So that's what we try to implement in the investment management field because it's a very competitive field. So we try to be the best each day in whatsoever manner, be it in client interaction, be it in picking up stocks, so on and so forth. So then I founded an health tech platform that was the Zomato for the fitness industry, if we could call it that way. So we scaled it up. It had around 150 fitness centers on it. It was by the name fitnessholic.com. Post that, the investment bug bit. This was around 2014. Then I worked in a couple of organizations In Deloitte, we worked on a lot of IPOs and private M&A transactions. So that got me into how the mind of how a promoter thinks. So all this, shaped up the investment philosophy, how the promoter thinks and how the investment banker would think while building up the book for an IPO. What kind of things they look for and how do they want to showcase things to the public. Then worked for a couple of large family offices managing their money in an India-based hedge fund. And then at one of the largest family offices, multi-family offices in India, where they advised around $3.5 billion, interacting with the best minds in the country. And that's where I realized how, what they're looking for is not the highest returns, but risk-adjusted returns. So that formed the genesis of our firm, which is Generational Capital as well as Perennial Fund. In fact, the names itself suggest that we are looking for long-term compounding and not the highest returns in the market. Like safety is the foremost criteria for us. Along with that, I'm also a guest speaker at Amity International, and I also am a guest speaker at EdLightened, that is an edtech startup where I talk about financial freedom and how to attain that. So this is a brief about me. Now, jumping to what I think about the macros and the economy. So, being a bottom-up stock picker, I try to advise clients not to get lost in the macro data. If we see the data from 2007 peak till now, the Nifty is almost up around 2.8x, whereas many companies have compounded our capital at more than 100x. So our job as fund managers is to identify those perennials which can grow their earnings at 20%, irrespective of the macros. Now, the key word here is irrespective of the macros, and I'll show you how we are trying to do that. The last couple of quarters were one of the best quarters for the Indian economy, with the corporate profitability to GDP hitting all-time highs. So this justifies why the markets are trading at these levels. And along with that, what difference I'm seeing now versus the past previous bull runs is that even in the small and mid-cap companies, there has been massive deleveraging exercise across all sectors of the economy. So you take any sector, be it steel sector, be it any commodity sector or the consumer part, there has been massive deleveraging. Debt has been taken as a bad word right now. So now what all this is leading to? So there is massive consolidation across sectors, and true capitalists with market dominance and superb execution are taking away market share. So these are the best time for organized players to create immense wealth. So we divide our portfolio into two parts, basically growth and defensives. So growth part is our technology, IT services and financials. They did pretty well over the last quarter. And defensive, we have pharma and consumer, where pharma did better than consumer. Now, how do I see the markets 10 years down the line? I know 10 years is a lot in the future, but going by how global trends have been shifting, I can foresee some massive trends which are underway. So if we see from 2015 to 2020, how the the S&P 500 has shaped up. So from almost negligible share of platform companies to almost 50% share in the S&P 500. That's what has happened in the USA. I see a very similar pattern happening in India. So 10 years down the line, everyone will be a tech analyst. Mark my words. Indian GDP is around 2.8 trillion right now, and the market cap is ballpark 3 trillion, a bit plus or minus. By 2030, if we grow between 5 to 7% real terms, nominal terms a bit higher than that, market cap would be somewhere between 5 to 6 trillion. Now, this additional incremental market cap of around 2 to 3 trillion, my strong feeling is most of it, if not all, would be through these new age tech businesses. And we are already seeing proof of concept of that. So, and they are very important part of the economy. Some people come to me and say that, what are they doing? They are loss making. But Zomato and Swiggy have more than 4.5 lakh delivery partners, surpassing that of TCS and India Post. Could you have thought 10 years back a food delivery company would be having more employees than India Post? So that is the kind of good they are doing to the economy. So we are on a constant lookout for these newly listed, growing tech companies, but they should have a road to profitability. And finally, we have one man to thank to who has made it possible. So there are no prizes of guessing that. It is Mukesh Dhirubhai Ambani. So when Jio launched, so now it made a mega shift in the how Indian consumer uses internet. So India right now has the lowest, cost per GB of internet since Jio was launched. The users of internet have grown approximately 4x, and now I think they are also launching Jio phone also. So that would do a lot of penetration into the rural tier T3, tier 4 towns also. So now all these consumer tech and the tech startups which are coming, I think it would not have been possible, or it would have been done at a very slower pace if the Geo movement was not there. So going ahead also, we see a lot of D2C brands like Mama Earth, Sugar, Boat emerging through this movement. Another trend we are seeing is phygital is the new normal. So now what is phygital? The old established institutions which were doing business the traditional way, now they are adopting the digital means. So for example, Maruti Suzuki, out of the 36 steps in its buying process, 24 has been digitized. So Dr. Lal Path Labs, so they are investing a lot on tech, and a lot of their collection is now directly happening through the app or through the online tech platform. So on and so most of the old age brokerages, I'm not talking about the Zerodhas and Angels, but like Motilal, IFL, they have also shifted mostly to the tech first platform. So the future will be tech, and which companies can adopt to it. Now coming to another sector which we like and we have very high allocation to. So we have around 25 to 30% allocation to the healthcare sector. So normally we get asked this question that why such a higher allocation? So basically our aim is to compound capital at 18-20%, irrespective of where the economy is, whether the economy is doing bad or good. So healthcare is the ultimate anti-fragile sector. So here I would take an example from a reputed investor who I follow a lot. So Pat Dorsey said most people could survive without coffee or the latest DVD player, but healthcare is one of the few areas of the economy that's directly linked to human survival. So even if we are in a recession, the healthcare companies would keep on compounding capital because they are compulsory consumption. So now some more views on the macros and the liquidity surge which is happening. So between 1912 and 2008, so this is a very interesting facet of the new era which we are in. So the Fed printed approximately $900 billion in total. Then after the global financial crisis between 2008 and 2019, the Fed expanded its balance sheet from 900 billion to 3.7 trillion. Then in the last 16-17 months, from that 3.7 trillion, it has expanded to 7.1 trillion. So what it did not do in the 109 years of its existence, it did in the last 1.5 years. So now this liquidity has to go somewhere. So either it can go to gold, it can go to cryptos, it can go to the equity markets. But the question is where in the equity markets? So now I try to find some answers as to where it will go into the equity markets. So normally liquidity will chase growth, right? Because most of the FIs and the large domestic institutions, they are looking for growth. So now we try to find patterns in the history globally as well as in India and try to see where they will repeat. So if we see the early 90s, which was the famous Harshad Mehta boom, so it was basically an infra boom when ACG and Ambuja kind of companies rallied, and globally also there was an infra boom. Then in the mid to late 90s, we had the Y2K revolution, which changed the face of India with the birth of entrepreneurs like Narayan Murthy. So in India, we had leaders like Infosys, Wipro, whereas in USA, we had companies like Yahoo, Microsoft, multiplying capital more than 100x. Then another trend happened in 2003 to 7, which was the commodity and housing boom, where a lot of commodity and housing stocks and their allies like banks and building material companies multiplied capital 100 times. So now what kind of trends we are seeing now? So currently the trend we are seeing is in the global context, it is the big tech, the FANG, which are popularly called like Facebook, Amazon, Netflix, Google, Apple. They are showing a lot of promising growth. So in the last quarter, if I'm not wrong, the top 5 these FANG companies at an aggregate grew their sales at 40%. And mind you, most of them are trading at market caps which are as large as the Indian GDP itself. So you can imagine the kind of hyperscaling they are seeing. So we are seeing the same trends happen in India. So like platform companies which are there, like say an Info Edge or an India Mart, they are showing decent growth along with the IT services companies. Going ahead also, we see the tech companies particularly doing pretty well. Now it is up to us to select which out of the tech stocks to pick. So now coming to what we do at the fund. So basically our whole aim is to compound your capital, because compounding in the day-to-day affairs is a very underappreciated concept. So I would just try to revise some of it. So normally we try to compound capital at 18 to 24%. Now at 18%, in around 10 years, 1 crore would become around 5.23 crore. But in 30 years, it would not grow at 3x at 15 crore. It would grow to 143 crores. So 1 crore would go to 143 crore. That is the power of compounding. And many people try to forget that, in these short-term volatilities. And why we are confident of doing that? Just based on the earnings growth of our companies. So the last 5 years earning growth of our companies has been 20% with a return on equity of around 27%, and they are debt free in nature. So how do we identify them? So over the past 6-7 years, while I have been investing globally as well as in India, what I have come across is globally all profit pools across sectors are getting consolidated in the hands of a few champion franchises. So, for example, in the global digital advertising industry, out of every $1 spent, 77 cents would go to Google and Facebook. In fact, there is a joke which my startup founder friends say that if I raise, say, $1 million, out of that, at least, $500,000 will go to Google and Facebook. So I'm working for them. So this is the kind of dominance some of these companies can build. And this is not only in the tech sector. If we take the animal health sector also, around 55% of the market share is concentrated in the hand of 5 players like Zoetis, like an Elanco. Now, if we come closer back home, the same patterns I can see repeating. So, for example, in the job search market, despite a monster multi-billion-dollar enterprise coming, despite LinkedIn coming, Naukri.com has built its monopoly, so it is having more than 80% of the revenue share and 110% of the profitability, because at an aggregate level, the other people are loss-making. And this is not only in large sectors. We see in small niche sectors also these kind of things happening. Like in the amines industry, there are only 2 players which are having around 95% of the market share. So our aim is to make a portfolio of already established leaders which will provide us consistent returns, and the emerging leaders which will provide us that higher returns over our peers, and make a very sustainable portfolio of around 15 to 25 stocks. So now what is our process? So first we identify sectors with consolidated profit pools. Then we will use our fraud search mechanics to identify the dubious promoters. And then we try to look out why this company would be the number 1 or 2, why there would be no impact if any other competitor comes into So we look at its capital allocation and its sustainable competitive advantage. So how do we identify clean accounts? So there is only one way of writing honest accounts and infinite ways of manipulating them. So due to my background into buy side and the investment banking, so what I have come across is, if I am the promoter of a company which is going for listing or is already listed, so I would normally try to increase its sales and profits. So at the and because the analyst community is only looking at that, so for that, what I would do, if I am not having genuine sales and I'm trying to fake them, so I'll try to shift that to increasing receivables. I will try to create fake fixed assets, fake current work in progress. In fact, if we look back in our history and establish fraud like Satyam computers, so they were showing cash in their books, but if we see the other income, it did not have any interest income. So these are the kind of checks and balances which we do. Then in case of financial institutions, the promoter or the management has the incentive to show high NIMs and consistent growth. So if they want to write off the NPS, they do it through the balance sheet, through the reserves. So even a lot of listed right now also regional banks are doing it, which are the favorites of the market. Then we run a 150 keyword fraud search to again check the intent and vision of the company and the management. Because in our view, as a famous fund manager also said in US, in evaluating a common stock, management is 90%, industry is 9%, and other factors are only 1%. So 80 to 90% of our time in research goes into checking about the company's forensics and the management integrity. So we try to look at the promoter quality, what has been the promoter background, what are their unlisted companies, whether they are doing most of their lucrative business through the unlisted company. And this is especially true in the case of MNC companies listed in India. Then whether they are pledging their shares, then if some litigations or court cases are there, right? And in this new age of social media and web portals, there are some very interesting handles which come across doing similar things, like a value picker or a Nitin Mangal, who's the champion in forensic accounting. And then why they are consistent and continuous resignation of CXO level people, basically. And why are auditors resigning continuously? So now you must be thinking that this is all very monotonous in nature. Why is he doing that? Kya milta hai ye sab karke? But there are very few interesting findings in it. So a leading diagnostic chain CEO, and mark my words, all diagnostic chains right now are trading at 100x price to earnings. So they were found with unaccounted cash. They have pledged all their stake in their company and are having real estate transactions, very questionable ones, left, right, and center. And this has not been acknowledged in a single broker report which I read. Another leading QSR chain, it is again the favorite of the market. So they have been pledging their shares, putting money into their other loss-making businesses, and are having very questionable royalty demands. A marquee FMCD company, they are having very good pedigree from a very reputed old industrial house, a 300-year-old industrial house. So they are cash rich, but they're taking loans from their promoter entity at 28%. So these are very interesting findings. Basically, they help us avoid, ticking time bombs, which are often ignored in the bull markets. So now we come to the quadrangle of wealth creation. So out of the 5,000 odd companies, only around 90 to 100 companies are left for us to evaluate. So now what do we look for in them? So firstly, there has to be a large total addressable market, because it is the foundation of massive wealth creation. Because if the large addressable market is not there, how will the company grow, and how will we as shareholders create capital? So for example, even if you take a large company like a Titan company, so Titan Tanishq is having around an 18,000 crore revenue, but the whole market itself is 3 lakh crore, and it is growing at 6-7%, the whole gold jewelry market, Tanishq can easily double its revenues in 4 or 5 years. So it is basically a large, shark in the ocean kind of a company. Then they have traits of maintaining that. Then we try to look for companies which have a reinvestment runway. So just to give you an example of what is a reinvestment runway, say I put up a factory today for 100 rupees. Then the factory generates a 25%, 25 rupee profit. I can again reinvest it to put another factory, and I keep on putting factory after factory after factory. So these are companies which can compound our capital at high rates of return. And if we get revenue growth, 15 to 20% revenue growth with these 20% plus ROIC, then I think we are in for a home run. So these, for just for example's sake, these are companies like Relaxo Footwear. So Relaxo, what it does is it only earns 10 rupees by selling one slip. It sells around
Satwik, can you just repeat the last line? I think there was some disturbance after Relaxo.
Right. So I'll take the Relaxo example again. Right. So now what Relaxo does, so for reinvestment runway example, what does the Relaxo do? It only makes a 10 rupee per pair profit on by selling slippers. Other competitors make very higher profits, but it sells around 18 to 20 crore pairs a year. So in that 10 rupee per share profit only, it does advertising from Salman Khan, Katrina Kaif, Siddharth Malhotra at such low margins. Then it again puts up factories. So if it is making 200 crore profit, it recently announced a capex of around 150 crore. It will again make a 25-30% ROIC on it. So now what it has done is it has the capacity which is around 8-9x of its nearest competitor in the north region. And in this lower end of footwear, no one can compete with Relaxo. So now, and finally, for management, apart from their quality and what their background is, we look for two more things. One is the capital allocation. If the management can allocate capital into business at high ROICs, or it can distribute capital if it cannot reinvest. So, for example, an Abbott India or a Nestle, or so they cannot invest capital back into the business because their business does not require capital for growth. At whatever rate they are growing at, between 12 to 15-16%, they can do that without capital requirement. So they pay out all that cash to the shareholders. So this shows the minority friendliness of the company. So now, what are the competitive advantages of the company? Because all information and all the forensics and the fraud search we did in the past, but all value and all returns I create, that will be in the future. So in the new age platform and the tech place, so you must already know these are the network effects. So what that essentially means is, if a platform has the largest number of buyers, or the largest number of sellers, the other party will automatically come to it. So for an example's sake, if Sankalpo is on Facebook and if you all are on Facebook, if I join some social networking site, so I will by default come on Facebook only. And then Facebook can monetize that sooner or later through ads or through paid promotions or other methods. So in similar way, in tech platforms, we see full network effects playing out in companies like Naukri.com. So Naukri.com has around 9 crore CVs. And now, to give some background, in the peak of the global financial crisis, when job search was considered a very bad thing, there was the largest recession. So then Naukri.com spent on advertising, building its brand. You all might remember the Hari Sadhu ad at that time, right? So from that day till now, Naukri has built a dominant monopoly, and it has around 8.5 crore CVs of job seekers. Now, if I am a business which is recruiting entry level candidates, so I would by default go to Naukri because that cost is a very low part of my PNL, right? And I can get the work easily done with very high quality talent. Then in commoditized industries, we look for low cost producers. So, for example, how we spotted DMart was. So, we have been tracking Costco and Walmart globally for over a very, very long time. So, now what they used to do was, for example, a Costco did not, set up their store in core in say a South Extension in Delhi. They would set up their store outside in the outskirts, and then they would make a hub and spoke model. So one store is in the outskirts, then 3-4 more stores would be in the periphery. So if I am a Unilever or I am a Nestle and I'm supplying to Costco, Costco can control, they have the bargaining power. So we were tracking the retail sector for a lot of time in India, and we were seeing, because the total addressable market is immense. So, but all the players, like you can name them, say what More did, what Subiksha did, what Future Retail did, they were scaling up very haphazardly. So we were looking for a player who could scale up, in a very calibrated order. And then came DMart by the investor who I, admired the most. They did the same model of what Costco and Walmart were doing. They would not put up a store in the middle of Bombay. They would put it up in outskirts and other stores in the periphery, and they would have the everyday low cost offer. So this led to lower costs every day, with more consumers coming in, and with more consumers coming in, they would have more profitability to lower cost. So this leads to a vicious cycle, and DMart growing very profitably. So now coming to another moat which we see in consumer and pharma companies. So this is of switching costs. So for example, so globally we have been invested in companies like Lonza and Thermo Fisher. So these are in the contract research and manufacturing space. So what trend I am seeing is, say if I am an Abbott, I am a Sanofi, or I am a Novartis, right? I am an innovator. So what the trend is happening is, the innovator now wants to only control the brand and the distribution. They do not want to get into the R&D and the process after that. They are like, if we get a partner of choice who's a trusted partner who can control our IP, then we can shift all this work to them. So they have been, multi-baggers, Lonza and Thermo Fisher, and have been more than 100x. So similar kind of pattern we see in companies like Syngene in India. So Syngene is kind of a platform. So India is like a hub of scientists. So if I am an innovator sitting in USA, I would recruit a PhD scientist there at $250,000. If I go to China, I would recruit them at $1 lakh. If I come to India, I get the same at around $50,000, right? So India is by default becoming a choice of the global innovators. So this is the same kind of boom which happened in the Y2K boom, basically in the mid 90s, when Infosys and TCS, like Infosys from a 500 crore company became many thousand crore company. So the same trend I can see here. So I call it global innovation and Indian cost. Then in some consumer brands, we have intangible assets. So if I talk about a company in the global context, there is a company by the name Tiffany's. So it is based out of UK, and it is a very premium luxury brand. So if you purchase jewelry from a normal goldsmith in London, he would take only around 4-5% making charge, but a Tiffany's would take around a 40% making charge, and the prices would be much higher. But the smile on the person's face who is receiving it would be very, very different. If for you giving a Tiffany's versus you giving a local goldsmith's jewelry. The same thing we saw very early happening in India with Tanishq. So Tanishq normally charges around 25 to 30% making charges on the gold jewelry. The same quality gold jewelry you can get with a local goldsmith at 5% making charge. But still, Tanishq is registering 18,000 crore of sales because people are trusting the brand of Titan, and that brand gives a sense of pride. So now this has led to Titan's gold business making around a 40% ROC, and it is still growing at 18 to 20% in steady state. So these kind of companies are very, very tough to find. So finally, our do's and don'ts of investment. So we mostly focus on 5 sectors, and these are very strategically positioned. So in a bear market, my consumer and my pharma sector allocation would protect me because these are low volatility, low beta stocks. So we have around, I think, more than 65% weighted to the consumer and the pharma basket. And the other part, which is the consumer tech and the IT services and the financial part, so these would give me the alpha in the the bull market. So because these are high growth, hyper scaling businesses. Now business situations we try to avoid. So generally, while evaluating a business or a stock, I try to look at as a business owner. So I generally do not get into companies which are not earning economic profits, basically a return on equity less than 15%. Then the business should not be dealing with government. So basically, like an infrastructure company, because there the receivables go for a toss. Then we avoid land bank and valuation arbitrage plays. So, for example, an XYZ public sector bank is at 0.5 price to book, whereas a Kotak Mahindra bank is at 4.5 time price to book. We would prefer a Kotak Mahindra bank over that. Then a bad promoter is in charge, and he is trying to convert. So these are typically things we try to avoid, because for us the safety of capital is of paramount importance. So these are few holdings, and as Sankalpo mentioned, these are just for educational purposes. So tech, we have companies like Naukri.com and L&T Infotech. We also have exposure to Nasdaq because we are very bullish on the FANG companies and the new age tech which are on the road to profitability. Then in pharma, we have large companies like Syngene International, or mid-cap companies like JB Chemicals, so on and so forth. But again, I would try to reinforce the fact that we are looking for companies which can double their earnings in 4 to 5 years. Now they can be and they have to be of defensive tech sectors. And so we launched the fund on April 1. So it's been 4 months young, or 4 months old. You can take it that way. So we have been consistently beating the benchmark, and like well diversified. We have a 34% allocation to large cap. Mid cap is around 40%. So we are generally not index hugging. And ultimately, now this is a very short term performance. So I would try to reiterate that we are aiming for higher returns and lower volatility than the benchmark, and not just because I'm saying that, because the portfolio has a much superior fundamentals. And in the limited track record also, we are having a beta of around 0.7 and a hit ratio of 75%. That is 75% of the months we have been beating the benchmark. So that was it from my side. And finally, like you must be wondering, like, why Perennial? There are so many fund houses in the industry. So firstly, like, unlike other corporate houses, so most of the families we manage at Generational Capital and at Perennial have mostly come from word of mouth due to our exceptional performances at our previous organizations here, because most of our focus was on risk-adjusted returns and return of capital rather than return on capital. Then we are having a fair amount of global experience, so we would be apt to identify this new age tech trends in India. And forensic accounting skills. So we have a couple of CAs who are certified forensic accountants by the ICAI. In fact, Vinayak S. Sood, so he's heading our forensic practice. So he has run models on companies of more than 200 companies before we launched this fund. and he helps us identify companies using these forensic models. And then not only from the fund management aspect, we have tried to position this fund from a family office kind of view, because of our background of managing money for domestic and international family offices. So we have tried to create an all weather strategy that focuses on safety of capital rather than chasing the highest returns while taking any amount of risks. So yeah, I think that was it from my end. And Sankalpo, now will be open for any questions. So these
Right.
are our brief.
Right, so we have a lot of questions that have come in. We will take one by one. So before that, let's just again reiterate for the benefit of the audience here. We discussed a lot of stocks today, all of which are purely for academic and educational purposes. These are not advisory it's not an advisory kind of a session today. So please exercise caution. Satwik or I might or might not have any interest in those stocks. So having said that, we'll move on. So a very interesting question that I will like to take, the as the first question is, I think I'll just check the person who asked this is Mr. Ankit Joshi. Okay, so perennial is a concept, or what you're trying to do is generate longer term sustainable kind of returns. And what happens is that a lot of such companies become very expensive multiple wise. Okay, they trade at premium multiples compared to other companies, maybe across geographies, Facebook, Asian Paints, Nestle. I mean, what's your take on high PE stocks or high valuation stocks in the middle of amidst a
Right, right.
multi-year bull run? And what do you think is their capacity to generate returns to investors during these bull runs?
Right. So normally, what we at Perennial do is, so before the fund was launched, we had been invested in, say, a Page Industries or an Eicher Motors. So generally, with these very high quality companies which are trading at very high valuations, we try to factor in what is the level of growth that is factored in. So, for example, at an Page Industries, the level of growth was factored in was 25%, whereas in Nestle it is only around 12-13%. Or in Asian Paints, people know that it won't grow at 30%, it can grow at 15-20% only. So till that amount of growth is maintained, we would stay invested in the stock. But when we are seeing that that level of growth would not be maintained, and they are high competitive forces, or the macros are such that those companies cannot grow at their previous levels, then we try to take an exit call. And I feel like if the kind of strategy I am kind of trying to run an all season kind of portfolio, it has to be a mix and match. So we would be having those high quality compounders like an Asian Paints, like a Bajaj Finance, like a Dr. Lal Pathlab, whereas we would try to find those emerging compounders, so like a JB Chemical.
Right. Okay. So just a follow-up question to that. It just came in from Mr. Anand. The question is, what P you have a discomfort with, or we can, we can have any other valuation metric which makes you a little bit kind of कि चलो ठीक है इसको रहने देते हैं, we'll circle back to this. Is there a level like that? Do you have something in
No,
mind?
so I am a business analyst first and a valuation analyst later. So first,
Right.
for me, it has to be, the sustainability of the cash flows, which has to be there. So for example, an Abbott India compounded its cash flow from, I think, 40 crore till to 800 crore in the last 12 years. Or Dr. Lal compounded its cash flows at more than 20% over the past 11 years. So I think sustainability of those cash flows is very crucial to me, even if it comes at a higher valuation. So I'm okay with that.
I think that's
So
a
what?
very important point you made there. We often forget that, we have to buy the business, not the valuation per se.
Right. And so
Right.
what normally we do is, so for just for educational purposes, say I like Dr. Lal Pathlabs a lot, the
Right.
business, the franchisee play, the high ROICs, but I am not very comfortable with the valuation. So instead of a 7% allocation, I would do a 4%, and try
Right.
to do a mix and match in the overall scheme of things. And when those valuations cool down, then probably I will again take a higher weightage in the portfolio.
Right. So, Satvik, today a lot of other fund managers are also coming up with, their proprietary forensic models, proprietary accounting standard models. Okay, so what is it that you think you are or your team is bringing to the table, and who do you think is the kind of investor that you are looking at when you talk about your perennial fund? So over to you on that.
Right, right. So what we are specifically bringing on the table is, so what we have seen in the competition, or rather than competition, we can say, our seniors or our inspirations is, most of them do only quantitative forensic accounting. The fraud search, the qualitative fraud search, that I have rarely come across anyone doing. So this 150 keyword fraud search, and this is based on what mistakes we made in the previous bull runs, what mistakes our team made in the previous bull runs. So that I have not seen any other Indian fund at least doing. And if I compare myself to what framework I evaluate for a global investor, so say I can, the frameworks would be similar to what a Terry Smith is doing in UK, or what a Pat Dorsey is doing. So those kind of frameworks I relate to more.
Right, right. So, Satwik, this I know because I know you personally also. You have also been a wealth manager, or you've been managing money for your clients in a non-fund manager way too. Now
Right,
you have
right.
also donned the hat of a fund manager. Okay, what is it that you have? I mean, what is your advice to investors on asset allocation in these times? Okay, come taking from your wealth manager days or your wealth manager experience that you still have. Okay, what is it that you advise to clients during times of a bull run like this? Okay, and how would you evaluate a fund, or what, I mean, typically how would you this was a part of my last question also. Who do you think is your fund for, and how do you probably suggest funds to, what kind of investors would you suggest, what kind of portfolios or products?
Right. So, firstly, on the asset allocation part, so I think when a client comes to our team or your team, so based on the risk appetite, we define an asset allocation. So now what happens is, in these times, clients tend to be very, very optimistic. So I have seen two extremes. Either clients tend to be very optimistic, and a 50% equity allocation guy would go to 70%, और दे टेंड टू बी वेरी पेसिमिस्टिक कि इकोनॉमी तो चल नहीं रही है, मार्केट इतनी चल रही है, सेल एवरीथिंग आउट. So for that, the emotions have to be in control. So we have tried to develop a few models which take the emotion out of the client as well as the RM who is managing the client. So based on multiples like market cap to GDP, price to earning, price to book value, and they have been very, very efficient in tough times like COVID also in managing the client's asset allocation, because there the human element goes out of picture. And secondly, if you ask me for vanilla asset allocation, so I think whatever the asset allocation of the client is, he should stick to that. But now many funds which are having exposure to cyclical stocks, which we call the low quality stocks, they have risen up a lot. So my genuine advice would be shift out of them to funds which are picking up quality stocks, and normally these would be focused funds, whether on the mutual fund side or the PMS side or the AIF side. The choice is yours, but you should stick to the quality funds now. And secondly, which kind of investors are we looking for, or who do we attract basically? So normally whatever families which we are managing uh, through the perennial fund, so they are mostly looking for the next decade. They are not looking for next 6 month 1 year return, and they are mostly promoters of listed companies, corporate CXOs, Bollywood celebrities. So they are seriously not caring about what my 6 month return would be. आपका alpha आया, इस fund ने इतना अच्छा कर लिया, that kind of thing, and they are looking for safety of capital. And even a 15% plus compounding would do wonders for them. But we are trying to select companies which can compound basically double capital in 3 to 4 years.
Right. Thank you for that. That was very detailed. And I think you've donned two hats, so you know how investors and how clients usually think about. It's got a very interesting question again. I'll club two questions together that Meenal and Mr. Anand asked. Okay, so how do you look at cyclicals? And the question of cyclicals comes to sectors also extends also sectors like PSU, PSU companies, public sector banks, probably one of the most troubled sectors like telecom, which, what are your views on that, and how would you probably look at these? Because how I understand, at least in telecom, the total addressable market size is huge. Okay,
Right, right.
it is virtually kind of a duopoly. Okay, so the reason I take telecom from Meenal's question is that it explains a lot of paradoxes probably. So how do you look at such sectors in general?
So normally, if we look at sectors like telecom or an airline, right? So
Hmm.
from early 2000s, they have grown their volume a lot. So basically, airlines due to value migration from railways to airlines, and telecom from for because value migration from the fixed line to the mobile, and now the geo movement. But no player is making money. So in telecom, even the best of best went out of business. Airline, there is a famous joke which goes on: if you have to become a millionaire, you start become a billionaire and start an airline, because there is no pricing power. The prices are set by the if I use that word, the stupidest guy in the room, or the guy who can bear the that kind of losses.
Right.
So basically, most of them would be setting up the lowest prices, and the other competitors have to go by those prices. So you can't be having pricing power there or bargaining power with the customers. So now, how do you make profits out of that? So most of the telecom companies have gone out of business, and most of the airline companies also have gone out of business. So then Philip Fisher also said that obvious prospects of growth in an industry do not mean obvious profits for investors, right?
Right.
And then regarding the PSU question also, so generally
Also
we try.
cyclicals.
Right. So PSUs and cyclical. So like most of the sectors are shallow cyclicals. So now we try to prefer shallow cyclicals over high cyclical. So if I am buying a steel company now, I don't know when to exit that. So then I will be in a lot of trouble, and clients won't like that. And in fact, I also won't like that. Whereas if I buy a consumer or a pharma company, high quality company, if something goes wrong, they give me time to exit. Right. And regard to public sector banks, so we have been, tracking them also, because we have been invested in leading private sector banks and NBFCs like Kotak Mahindra Bank, like Bajaj Finance. So what we realize is the entrepreneur. There is no entrepreneur there, right? If an Uday Kotak is there, so he is the richest banker in Asia because of his wealth in Kotak Mahindra Bank.
Right.
And a lot of it is tied up to that. PSU, that is not there, so the incentives are not aligned.
Right. So you feel as businesses, PSUs are best avoided because the heart and the mind might not be in the right place. Okay.
Right.
So again, these are not stock advices. In the comments, you're getting a lot of things about Rakesh Jhunjhunwala getting into airlines. We won't touch that because that is beyond the scope of this discussion, at least. What I want to ask you is a personal question again. So you think, you've told us about your experience of looking at US companies, okay, investing in new kind of businesses, new platform businesses. What do you think of uh, makeup of a of these new age companies coming to the public markets? Okay,
Right.
Zomato, Policy Bazaar. I think at some point in time, Paytm is also looking to get listed. What do you think of those companies coming in? And a lot of people describe these as hope trades. Okay, what it means is that, what I understand what hope trade means is that you're hoping that the revenues will continue growing, and at some point in time the sector will have only one player who drives the revenue, and who drives the sector and has the largest share of the revenue, and thus becomes very profitable. So that's a hope,
Mhm.
and that's a hope trade a lot of people are calling. So what do you have to say about that?
Young entrepreneur as a participant in the financial markets. So I'm very happy that companies like Zomato are listing on the Indian exchanges. So can you imagine, like, say 15, 20 years back, teacher's son in Muktsar in Punjab, he would be running a decacon, right? That time he was in such a state that he would fear for his life, and now he is running one of the largest companies by valuation metrics in India. So it makes me happy, as a market participant. And also these new age companies, so if we talk to the foreign family offices which we interact with regularly, so a couple of years back or a year back, they used to say, where do we invest in India? Because you don't have those sizable platform or tech companies which can absorb, large millions and billions of dollars. So now at least we are getting that kind of traction. But having said that, of my experience of investing globally in platform companies over past 5 6 years, what I have seen is the sustainable models are those which normally have subscription based revenues.
Right.
Right. So basically, once the client is acquired, the client keeps on paying that
Contributing to the revenue.
for contributing to the revenue, and then obviously most of them are market leaders and are on a road to profitability. So in the Indian context, if we see, so one of the oldest consumer tech startups, if you call that a startup now, so basically a Zomato's investee company like an InfoEdge. So, the customers take 3 4 year kind of packages for their job search engine. They make around a 50% plus EBITDA margin. ROICs are more than 100%. So those kind of companies we like. And it's not that all companies are loss making in the tech business also. Let me tell you, in the new age platform companies also. So there are new age companies like CarTrade is coming just with an IPO. It is a leader in the car search engine. It is having very pretty decent ROICs, 20% EBITDA margins. We have to pick and choose which kind of companies come. But one thing is for sure, 7 8 years down the line, at least 50% of the Nifty would be tech.
Right, I agree with you there because I myself am a part, and I we also run a very platform based business, and leverage a lot of tech, to reach people. In fact, all of this is also on similar lines. So I concur with you. Okay, there's a huge kind of potential for this kind of businesses to come in, and I think this might be the future also. Okay, so we will take a quick comment on you, on the more behavioral side of investors. You've been interacting with family offices, SNIs, ultra SNIs, who are investors, or are looking contemplating to invest. What do you think is the general mood, or what do you think they should be probably thinking about while they invest, or their current investments?
Right, right. So since COVID has happened, there has been a huge shift even in the old mindset kind of families. So normally the families which we interacted with, so most of their wealth would be in their business, and this would be hundreds of thousands of crores. And stock markets and financial assets used to be looked as gamble. I'll just put in a few lakhs or a couple of crores and you play with it. But now they are considering it serious, and the definition of long term has increased. So from a couple of years, the long term has gone to 8 10 years, because they have also realized if they put their money in an FD or an RBI bond, it would give 6% at best. So pre-tax also you would compound your money at in 12 years. In equities at 14 15% also you are getting around 4 4.5x. One standard deviation would give you 3.5x on the negative side and 6x on the positive side. So even your semi worst case scenario also is much better than what a fixed income could give. So they are looking for managers who can develop that long term kind of mindset, not looking at that monthly alphas or momentum chasing, sticking to their philosophy, picking up the best companies which can grow irrespective of what the economies are doing. And not only in the listed space, even in the private equity space, we are seeing a lot of traction to these kind of managers.
Right. Thank you. So that was again very insightful on what the investors are looking at. So I've got a couple of questions more before we kind of wrap up today. Vivek asks, and why I'm asking you this is that you've given a lot of perspective on a lot of sectors. One, very loved sector right now is chemicals. Okay.
Right, right.
So, what do you think of chemicals as a sector? And the other question that, I mean, not as a follow up, but a separate question, but you can answer that after this is, what is the kind of drawdowns that you would want your investors to be ready for, or what would you say that this is the kind of look, boss, this is the kind of volatility that you have to come prepared with? So,
Right, right.
these two
So,
questions.
firstly, on the chemical sector, frankly, over the past 1.5 years, I have been reading up at least 10 companies but I failed to understand them. So be it alkyl amines, PI Industries, Naveen Fluorine, I have tried to read about all of them, but since I'm not obviously from an engineering or a chemical engineering background, it is very tough for me to understand what goes behind them. And unless I understand the business, how will I forecast what its demand would be, how it would go in the
Right.
future? So we have zero allocation to chemical companies. And regarding the drawdowns, so one thing you can be sure, so like our pharma and our consumption basket along with gold also, so that would protect us a lot in the drawdowns. And also we have exposure to Nasdaq. So if the the markets fall, we would get a dollar depreciation appreciation benefit also from there. So having said that, when we were managing our personal money during COVID, so in that year also the portfolio was in the positive. But leaving that apart, it would be one of the most low volatility products in the market which you can see. So that one thing I can assure.
Right. So just if I had to ask for a number, I know your fund came a little bit later than the COVID crash. What is the kind of drawdown you would have envisaged for your fund in March 2020 had it been in existence?
Right. So actually, the same portfolio only we were doing it for the personal portfolio, and we have been maintaining a little track record of it, how we are doing it month on month. So in
Right.
that year, we were up around 9% in that March to March year when the indices were down. So that was mostly due to the pharma stocks like say a Dr. Lal or an Abbott or consumer stocks like Nestle doing well. But again, there are no guarantees in this.
Right.
Right.
No, I understand.
But
So this is just for the more broader purpose of discovering or knowing more about your fund. Okay, with this last
right.
question, I think it's a very interesting question. We will wrap up today's session. So you are a young investor. I am also, a professional with around 6, 7 years of experience. So as professional, this is probably the first major bull run that we are seeing. Okay. And a lot of new investors are coming into this, attracted to this bull run, are coming into the markets. Lakhs and crores of demat accounts are open, are open. So what is your advice and what is your learning, or how are you proceeding into the market as a young fund manager? Can you just share your advice or your learnings to the benefit of these new entrants in the stock markets?
Right. So I have been investing from around, you can say, late 2013, 14. So basically a couple of bear markets I have experienced in personally, and obviously I've read about patterns of what works and what doesn't. So normally what happens right now is we would see a lot of sectors which were not doing well now suddenly rallying, and a lot of low quality stocks rallying. And especially on fund managers like us, there is a lot of pressure. So for example, if I would be having a Nestle India or an Abbott which hasn't done move for the last 1 year, suddenly my clients would come up to me and ask that, boss, kya chal raha hai, markets have doubled, why don't you go into that chemical stock, or that API stock or metal stock? But again, those kind of temptations you have to resist, because you are there for the long term game. And these kind of things pretty much vanish when the markets correct. In fact, in the last couple of days only, I was getting a lot of DMs on Twitter कि क्या करे market में, there were a 4 or 5% correction in the mid and small cap indexes. So for people who have not seen proper bear markets, it is best to go with tried and tested compounders, and obviously everyone learns through their own journey.
Right. Right, so that's very interesting and very insightful. Ladies and gentlemen, on the call, I have shared the link for Satwik's website. You guys can visit and check out his portfolio for any queries. You can always write to us. You can book a call with PMS AIF World, and we can help you reach out to Satwik or help you choose investments in general. That's it from our side. Do for more such videos, you can look at on our website, or subscribe to our YouTube channel. We keep doing this every Friday. Thank you, Satwik, for being with us. It was a very insightful concept, and a lot of new things came our way. So over to you for any closing notes, or and then we wrap up today's session.
Right. No, so it was very insightful, and interacting with you and the clients which were there. And so again, one thing I would try to reiterate it: don't go after returns this time. Try to focus on safety of capital. and both from a family office manager and as a fund manager, that doesn't mean going into debt or cash. That means going into safer equity strategies. So this would be my limited closing remarks.
Right. Thank you, Satwik. Thank you to the
Thank you.
audience. We hope to see you soon again. Thank you.
Thank you.